Good morning and welcome to our live webinar, How Private Foundations Can Leverage Inflation Reduction Act Provisions, hosted by PCAF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate on today's call. We've taken a screenshot of the attendee interface and you should see something that looks like this on your own computer desktop on the right-hand side. You will have the opportunity to submit text questions to today's presenters by clicking on the questions button of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 1 CPE credit in taxes, and you will need to respond to 4 of the polling questions to receive credit. If you are having difficulty responding to a question, it is recommended you come out of full screen mode to respond. CPE certificates will be issued within 8 to 10 days via email. A copy of the PowerPoint slides and a recording of today's webinar will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Anan Samara, partner of the Private Foundation Practice with PCAF O'Connor Davies. Anan.
Thank you, Alana. Good morning, everyone. We want to thank you all for joining us today for our discussion on how Private Foundation can leverage the Inflation Reduction Act. Through this webinar, we'll talk about some of the various types of credits that may be available for private foundations, some of the eligibility requirements, of course, and how foundation can go about claiming some of these credits. We have a little over 100 now, or at least over 100 registered for this webinar, so we are excited to go ahead and get started. Before we do that, just a quick brief introduction. Again, my name is Anan Samara. I am a partner with the Private Foundation Practice at PCAF O'Connor Davies. I also co-chair the firm's Diversity, Equity, and Inclusion Council. With me today is my co-host and fellow partner in the practice, Scott Brown. Before, just to really take a step back, we as a firm now work with a little over 600 private foundations, and we always say not two foundations are alike. So this is not really a one-size-fits-all. Depending on the foundation, how the foundation operates, of course, and the type of assets may or may not be eligible for some of these credits. I think just as important, we always talk about with our clients about how they could assist the grantees other than just making grants, and this is one of those areas. Many of your grantees may be eligible for some of these credits, and this is one way you could educate your grantees on those credits. With us today are 2 speakers. Our first speaker is Sandy Weinberg. Sandy is a partner with the firm. Sandy heads up our tax credits and incentive practice. He actually has done that for the past dozen years or so. The practice focuses on R&D, jobs, and energy credits at both the federal and the state level. Also with us today is Nicholas Rochedieu. And Nicholas, I think I got your name right. If not, I do apologize. Nicholas has nearly 20 years of experience in public accounting and specializes in state and local taxation. Nicholas works exclusively on nexus studies, voluntary disclosure agreements, and state credit studies as well. Welcome, Nicholas. Before I turn this over to Sandy, just want to remind everyone that this session will be recorded and available along with our monthly thought leaderships and past webinars on our website. So for those of you who may have some downtime and looking for leisurely reading or listening, feel free to get on our website. With that said, I'll turn it over to Sandy. Sandy.
Thank you, Anan, and to all of you. Welcome to our presentation on clean energy opportunities through the Inflation Reduction Act. As Anan said, this morning we're going to discuss how nonprofits and particularly private foundations who are really looking to reduce their environmental impact. And what they have found now is a game changer, and that game changer is the Inflation Reduction Act. It's also called the IRA, as you may have heard, and it really was federal legislation that was passed in August of 22. So if you're a private foundation that wants to install solar panels or implement geothermal heat pumps or install a wind turbine, this is your time to do it. Thanks to the IRA, tax-exempt entities like private foundations and even state and local governments, as strange as that may seem, they can now receive direct payments from the federal government, and these are in lieu of tax credits. And they're for clean energy projects that are placed in service starting last year. And there was a lot of clarification at the end of last year as to how things can be done, and the portal was opened at that time. But for a while now, clean energy credits have been available to taxpayers. Those are entities that actually pay tax. And for them, the IRA actually expanded the credit opportunities. Taxpayers can now even transfer the credits. But at the same time, private foundations had implemented sustainability goals. We've heard this, through our brethren here, as well as from clients that would call us. However, it's only been in the last year that private foundations have been better subsidized by the federal government to take advantage of these the clean energy opportunities. So what can a nonprofit expect? Well, depending on a number of factors and the credit that's being sought, what private foundations can get is really a 30% credit, or even more, as it's possible. We'll get into those details of the project's cost. So project costs $1 million is an opportunity for, excuse me, 30% of that, 300,000, or possibly even more, as we'll get into. But first, you have to get to that 30% level. And for example, under the energy investment tax credit, you only get to that 30% credit if the project developer is paying prevailing wages and meeting apprenticeship requirements. Otherwise, you're looking at a 6% credit. So it's very important to make sure all the rules are followed to get to where you need to go. Now, Nick Rochedieu, who Anan referenced, my partner in the credit practice, is going to dive in on some of the key elements that are needed to capture the energy credits. But if we get to that 30% credit, you could actually increase your credit. And you're going to hear that one way to do that is to have, for example, the materials used at a certain level, meaning a percentage of the materials has to be domestically produced, made in the US. If you can get to those levels, you get an extra 10% credit. And there are over a dozen credits that private foundations are really eligible for. Two of the biggest are, one you heard me reference is the Clean Electricity Investment Tax Credit, and another one is the Clean Electricity Production Credit, the ITC and the PTC. So what are the steps that a private foundation needs to capture the credit? And we'll go into much more detail, but know the basics first. To take advantage of these new direct pay opportunities, you have some filing requirements. First is pre-registration. Your private foundation must register the project on the IRS portal. The portal just went into effect. It went live in December of 2023. There have been some glitches. Those have been taken care of, at least as far as I've heard. But a couple of pointers that we have learned. One is only file for pre-registration after the facility, in other words, the solar panels or the wind turbine, are placed in service. That's a term of art, but you could get the gist. The second, there's a pretty lengthy backlog because of because the portal did not go into usage until December. And if you see the instructions, they say make sure to budget 120 days from when you register to when you will have the opportunity. So get in line quickly after it's placed in service. Finally, be aware that each applicant is only allowed one registration package per year. So there is more, if you have more than one property where you're doing building a facility, package it with the others. So when that process is done, the IRS is going to provide you with a registration number. That number will need to be included on an original, timely filed Form 990T. What's that? That's a tax return. And for those entities that never filed a tax form, now you will. That doesn't mean you pay tax. It's just the mechanism to capture the direct payment. There are other credit forms that would be part of the 990T. There's a general business credit form, and there's other specific credit forms, and we'll get into that. Once it's processed, the IRS is going to issue a direct payment. And two things to be aware of with respect to that. There are no direct payment is going to be made by the IRS until the due date of the tax return. So if you placed it in service this year, your taxes until next year, of course. You don't need to rush on that front. However, be aware that you can't make the direct pay request on an amended return. So you got to get it right the first time. That's an important point to remember. And so in short, private foundations, for private foundations, the direct pay opportunity is pretty exciting, and but it's complex. So our strong recommendation is going to be to seek tax advice, possibly legal counsel as needed. We'd be happy to assist, and with that, to dive in on the details and the opportunities for private foundations and other nonprofits, here is Nick Rochedieu. Nick.
Thanks, Sandy. Thanks, Scott, Anan, and also Sandy. Welcome, everyone. As Sandy just outlined, we'll be talking about some of the benefits that are out there now that historically didn't exist for what we'll call, I'll use the group term of 501. So 501c type entities, nonprofits, private foundations falling underneath that umbrella. So we're going to talk about the Inflation Reduction Act, which obviously everyone signed up for this is aware of. This is sort of our high-level agenda that we want to talk about. Again, just sort of the high points or low points, depending on what side of the political fence you happen to be on. Talk about the goals of the Inflation Reduction Act, the credits that are available, what those mean, and Sandy mentioned two of the main ones, which are the production tax credit and the investment tax credit, the PTC and ITC, and then really the nuts and bolts, the mechanics of how do you claim it, what do you need to do, and ultimately the key here is substantiation and documentation, which I'll say several times throughout this presentation today, but that's really going to be the theme throughout. And then talking about direct pay, which Sandy went through in good high-level detail, and then also the possibility of transferring the credit not for nonprofit private foundations, but the capability as for-profit entities to generate and transfer the credit. Next slide, please, Alana. So polling question 1, and should hopefully pop up for you. Has the foundation received any emails about the IRA, benefits and incentives? Yes, no. What is the Inflation Reduction Act? And possible. I get a lot of emails. So we'll give everybody sort of 30 quick seconds to answer that one. Again, just to sort of housekeeping wise, to get CP, you need to answer the polling questions, and we'll have those results come up in a quick moment. So I would say in the interim, obviously there's been a lot of news around not only the Inflation Reduction Act, but a couple of other ones out there. And we'll talk briefly once we see the answer here about some of those impacts that are part of the IRA that's a byproduct of either the IRA other sections or prior, sort of we'll call it COVID time period statutes. So hopefully everybody's been able to vote. Well, can we close this one? Perfect. Excellent. People do get a lot of emails. We'll talk about what that means from a third-party perspective. There are a lot of marketing firms out there. Again, we'll talk about that at length later on. But the answer of no is probably a good answer to a certain extent, because we can at least sort of educate and say, hey, there's a possibility out there that may make sense for you. So next slide, please, Alana. All right, so the IRA goals, And this is where things get, again, not politicizing this at all, just go to high level at a couple of the notes that came through. So next slide, please. So as Sandy mentioned, the IRA, and this is sort of a very brief overview just to give sort of a framework around what we're going to be talking about for the rest of the time. So signed obviously on August 16th of 2022. And just to be very clear, and this is sort of a name thing and more intriguing from the standpoint of a direct quote from President Biden, who actually said it has nothing to do with inflation. That was on a campaign swing, which really inflation is nothing more than sort of a term of art that they decided to use. The real goal here, which you see down below, is really from the carbon footprint / economic development in the green energy space. So you can see here the emission reduction, which we'll talk about, clean energy jobs. Blue-Green Alliance was third party that they did a lot of research behind this. The U.S. supply chain, the CHIPS Act, which we won't talk about today, but that was the concern about certain countries who have both access to rare earths and a lot of chip technology / capability. And then the last 2 or 3 are somewhat intriguing, and I'll say this again, not to politicize this, but taxpayer compliance. The vast majority of the spending related to the Inflation Reduction Act was actually related to pushing people into compliance. So there was over 40 or $45 billion as part of the funding that was actually earmarked or pushed towards improving compliance. Lowering healthcare costs is an interesting one from the standpoint of it's tortured logic to get there, but that was one of their stated goals. And then lastly, funding the IRS, which you talked about for improving taxpayer compliance. Everyone heard the $80 billion number or fact when it came out. There's been obviously some political hot potatoes around that, but that's sort of, they still have it. It's still been earmarked. They are in hiring tear. The IRS, I believe, from an open positions significantly has been bulking up their folks. So the CBO you can see here and the $400 billion in federal funding. The vast majority from a CBO standpoint, they said, we'll have a budget deficit reduction. However, this federal spending is going to ultimately end up at $2 trillion over 10 years. So significant any way you cut it. It's more important to understand this was a large bill with a lot going on in it. We're focusing on a very small section of it, but good to understand sort of the overall framework. So next slide, please, Alana. To go in a little bit to give, again, context to the credits we're going to be talking about. This was really, again, this was a year in. The White House came out with their own release, which again, depending on what you view there, there's measurement questions here. The real key here is the electric vehicle supply chain, the solar manufacturing, and clean energy manufacturing was significant. All of those are significant real dollars that there are being, it's advantageous to sort of take advantage of those. And it's something to really keep in mind that it's not small dollars at stake here. So the benefit is open to a lot broader group of people than what it used to be. And lastly, the idea was here again from a carbon footprint standpoint, 1 billion tons of carbon dioxide reduced in 2030. And I went back, fact checked that, and actually is in 2030, that is the goal, to go from tons of carbon dioxide reduction in 2030. So this is again the White House, so for whatever it's worth, that's where they're at. The clean energy jobs and the spending on green energy is significant and continues. So next slide, please, Lana. And just to sort of focus back again, last one before we start to get to the sort of meat and potatoes of today, that the bipartisan infrastructure bill and the IRA talk about the billion tons. This is Department of Energy actually verifying the White House, which is not particularly surprising. Clean energy, you can see that the Department of Energy expects, and this is an expectation, so wherever this ends up, 80% clean energy by 2030. Again, that's within our borders, so there's some questions around that about what that actually means, what blend that is, and whether or not it includes some other, what people believe are, we'll say, dirty versus clean energy. So electricity generation from wind, and this is one that we'll talk about specifically just because we'll sort of split offshore and onshore wind and a couple other things. And solar generation is increasing 7 to 8-fold, and that's already starting, which everyone can obviously see sort of by the price of solar arrays and solar panels on not only your house, but also commercially, but also the expansion not only in charging stations for EVs and for green energy sort of progressive initiatives. So lastly, I put this in because I thought it was sort of intriguing, especially for our current audience. And you can see down below that from an investing organization, again, under that 501 umbrella, it's $1.6 billion for implementation. So The reason is sort of, I guess, twofold. One is there's some level of altruism there, which is sort of the underpinnings of what we're here for. And then secondarily, there is a return now as part of the Inflation Reduction Act that, again, is going to be beneficial. So Alana, if you go to the next slide, please. So this is one that I will say this is somewhat dry. I wouldn't deny that by any stretch. But what I'd like to do is I'd like to focus throughout this there are a lot of good resources out there. So I would say that you can see here I put exactly down for DOE, IRS, and White House. And that's purely because there are a lot of other firms, a lot of other groups putting out information. Usually I like to link directly to the source. So these are the most reliable sources. PKF has got some articles out there as well. I would suggest if you have questions, reach out. We've had a couple articles in the Inflation Reduction Act, and especially as part of this presentation, as Sandy mentioned earlier, we're here to help. So I put this in here, and again, when PowerPoint goes out, I believe the links will still be live. If not, it's a copy and paste, hopefully. So next slide, Alana. So polling question 2, has the foundation taken advantage of any incentives exclusive to today's topics, or even if you have, the federal or state level? And yes, no, or I'm still here and listening, or multitasking, which is a sign of the times. And what I'll say, sort of referencing back for the resources that are out there, and this will be again a theme, substantiation documentation is key. There's a lot of interpretation because there are a lot of open questions right now in regards to certain regulations and certain mechanics. And as Sandy mentioned earlier, again, there was some hiccups in regards to the online portal that most of which have been taken care of. And I'll call it they're both technical glitches from the standpoint of the actual technology and the back office or back end processes, but also there is some gray area in regards to some of the requirements. So it's one that, again, very sage advice, which is to get your friendly accounting firm, legal counsel involved to make sure that everything from an administrative standpoint is taken care of. And then a technology front, again, Darius is getting much better at sort of the portal. Now that they rolled out in December, there's been, again, I've heard some year-end hiccups, but hopefully, knock on wood, it's getting better each day. So with that, we'll give another 10 seconds for people to respond. Perfect. So people are taking advantage, which is great. That's a great answer. Obviously, there's some folks that have got some, I would say, some stories around dealing with having to get this through from the standpoint of administration and from technology. And appreciate the folks still here and listening or multitasking. Definitely appreciate it. It's that time of year, especially in our tax world. So definitely appreciate the attention. So next slide, please. Excellent. So let's get into sort of the IRA incentives. So next slide, Alana. So as discussed, and we're going to go into each of these in some level of detail, but really the key here is once you know what's out there, then you can sort of cycle down or narrow down what you really want to look at. So I put the IRC sections in here, and there's a reason for that, and I'll get to that in a few slides. But really, this falls under the clean energy, which is the direction that we were trying to discuss today. There's a lot more out there. These are the ones that people sort of either have talked about or have heard about. So the production tax credit under, put the Internal Revenue Code sections, and again, we'll talk about the chart that that's related to. But really the production tax credit, which Sandy mentioned, IRC section 45, that's your wind, your biomass, geothermal, solar, hydropower, and hydrokinetic. The energy investment tax credit, or the ITC, which is under section 48, that's the 30% credit that Sandy mentioned earlier that we'll talk about. That's based on cost, and that's photovoltaic, geothermal, battery storage, and a couple others. And then the last two are really focused on, this is much more of, I would say, it's mostly through dealers and mostly through what I call some of the solar companies, which is the electrical vehicles credit and charging infrastructure credit. And this is one really to keep an eye out for if you happen to have either a grantee or some level of activity at the electric vehicles. There are the credits out there directly through dealers for EVs, and then for charging infrastructure credit as well. That's something that's out there that should be sort of considered if you happen to have something in that realm. And this is and again, I'll reference Tesla just because it's the most ubiquitous. These are your EV charging stations. And again, this are low income or non-urban census tracts, which is somewhat limiting, but it's out there and we didn't want to leave that out. So next slide, please. So this is a chart that was put out This governmental chart, I think it's particularly good, and I say it's particularly good because it gives a very high-level approach to a very complex area. And this is what the two will mainly focus on is the ITC and the PTC. And just to highlight a few of the things here, and again, it's tough to read, so hopefully when you get it in front of you, you can expand it, take a look. But really the key here is, I guess, the first 2 to 3 columns, and then the start of construction. So as you can see, the ITC, there's sort of 3 buckets there, and the low income, we'll talk about what that bonus is. And the base rate, you can see, Sandy mentioned earlier, 6% for construction in 2023 going forward. And then up above, you'll say full rate. Well, what does that mean? We'll talk about prevailing wage requirements and labor requirements. That's your 30%. And embedded within that and down below, we'll say production tax credit, just to be very clear, it's over 10 years. You don't get sort of a boatload up front. It's spread out over 10 years based on your actual production. So we'll talk about that in some level of detail. But the key here is if you look at the very top for ITC, 30% if you meet certain requirements can be enhanced by 10% for domestic content. We'll explain what that means. And then energy community bonus for 10%. So in theory, if you meet all these certain requirements, there's a 50% return on the investment. And with it being direct pay, that's essentially will sort of halve what your investment may be. So it's definitely worthwhile to see if you can do those enhancements, and really reviewing those projects. It's always key, again, documentation, substantiation. There is a 500% increase, you can see here, from 6% to 30% if certain requirements are met. So documentation and due diligence is really, really the key here. So next slide, please. So this is one that I put in here just from a standpoint of there's a couple different geographic locations that would be worthwhile. These are more grants. These are a possibility. They're not anywhere near as popular as the ITC and PTC, but there are certain reduction funds that there are direct grants that are out there. So again, it may not be as utilized in this 501 space, but something good to keep in mind, especially if there's looking to a grantee who happens to be in a particular geographic area. So that geo platform there, it's not ACRIS, which we'll talk about later from a location standpoint, but that map online is actually, you can determine what incentives may be available based on the location, and that goes down to street level. So there's a greenhouse gas reduction fund, access to solar for socioeconomically depressed areas. And again, the other ones are more governmental and Tennessee Valley Authority, but really that access to solar and greenhouse gas reduction fund can be valuable. That map has other incentives sort of embedded in there. It's worth a look if you have to be looking at a grant somewhere that happens to be able to avail itself of those. So if you go to the next slide, please, Alana. So now we're going to get into the individual PTC and ITC pieces, really to key into the production tax credit, construction before January 1st of 2025. So the window is slowly closing. There's obviously some other years you can see in that chart, but really the key here is before January 1st of 2025, that lower quadrant of that graph really needs to look there. It's a 10-year credit. So again, I'll do some difference, some compare and contrast. The investment tax credit is sort of a quick shot, 30%. We'll talk about place in service shortly, but this is really a longer term. So it is somewhat of an annuity. Generally, it's less than one megawatt scenario here. It could be wind, biomass, geothermal, solar, small irrigation, landfill, hydropower, etc. So, and just to be clear, I want to make sure because my decimal points, it's 3 cents per kilowatt hour for trash, hydro, and biomass, and 0.55 cents per kilowatt hour for wind on and offshore, closed loop biomass and solar. I was going to put it in cents, but I figured just if you take whatever the kilowatt hours are times this, that will be what your credit is. And the enhancements you can see from that prior chart is 500% enhancement for varying wages, labor, and a couple of the other items for lower income communities. And just to be clear, this is one that is from a funding standpoint. If the credit utilizes tax exempt bonds, which I don't think is anyone on this phone call, but again, if we don't mention it, then maybe that one instance, you actually have a reduction in credit if you're funding the project with tax exempt bonds proceeds, tax exempt bond proceeds. And then just to be clear, this is up before January 1st of 2025. That chart you'll see later on. There's a clean energy production tax credit. They just changed it. So as of 1/1 of 25 forward, it'll be that. So the name changes slightly, the terms don't really change too significantly. And it's transferable not for 501s, but transferable for for-profits and refundable through direct pay for 501 or nonprofits or private foundations. And I just put the form down there. This is an addition just from a mechanics standpoint. 8835 is where the details go. 8835 then goes up to Form 3800, which Sandy mentioned, which is your general business credit. And then that goes onto your 992 with a checkbox asking for direct pay, and you'll attach all the sort of associated documentation, your pre-filing registration number, details about what you're doing, and the request for direct pay. So 8835 to 3800 to 992. Next slide, please, Alana. So the investment tax credit, as was mentioned earlier, construction before 1/1 of 25, and then we'll talk about what that's replaced by. This is 30% on qualifying expenditures, and this is presuming for the moment. This is on prevailing wages and labor. There are other enhancements, which we'll talk about further on slides, but generally fuel cell, solar, geothermal, it's where you get essentially your qualifying expenditures, and once you do pre-registration, you go after it, you get it in that year. So again, this isn't an annuity unless you do different projects, and obviously your expenditures go out. Whereas the production tax credit, you've got somewhat of an annuity, so it may start out slowly, but net you could possibly end up with the same dollar amount. It's just over 1 year versus over 10 years. So this is an either or, just to be very clear. You can't take the investment tax credit plus the production tax credit. Something to keep in mind though, as you're looking through it, we have seen that there's an if type analysis that takes place where you've got one sort of bracket up at the top, which is, does it make sense for a production tax credit versus investment tax credit? Looks at current value of those dollars and then pushes them out over expected production over the next 8 to 10 years. So again, this is replaced by the Clean Energy Investment Tax Credit, and this is post 2024, so 1/1/25 and forward. And then you can see it's transferable for for-profit entities and refundable for nonprofits through direct pay. And just to be clear, this is Form 3468, which starts at the investment tax credit, rolls up to Form 3800, and then ultimately rolls up to Form 990T. So next slide, please, Alana. So this one is, again, similar to the grant. This is not particularly significant from an activity standpoint, but if you have to be partnering or you have a grantee who is looking at re-equipping or expanding manufacturing and working to make it more green than otherwise would be, this is a little bit difficult in the manufacturing realm just due to current and existing EPA requirements. However, if it is sort of an update, and this is available to 501s for direct pay as well as for-profit entities, you can see qualified investment costs of 30% and 6%. So it's very similar to your ITC and PTC. This just happens to be in a manufacturing context, or if you've got an industry that has been particularly not as green as it otherwise would be, if you can meet that 20% threshold in reduction, this is a credit that would also be worthwhile if you happen to exist in that space or have a grantee in that space. So next slide, please. So polling question 3, has the foundation received any external petitions for funding in this area? Yes, no, or I'm still here listening or multitasking. And what I would say, again, since we're talking about the Advanced Energy Project Credit, the ITC and the PTC, this is one that you'll have a lot of third parties if you're going out and looking for something to invest in, or they're coming to you. There's a lot of economic studies that go behind this, and that's not only just present value of money, that's also trying to figure out for the construction funding, the timing, what it looks like, and meeting those requirements. And again, I've said it several times already, I'll continue to say it, documentation and substantiation of these is key. So if you are using a third party, whether it be a law firm, PKF, or internal resources, just to make sure that whoever you're working with on what I'll call the production or the manufacturing or the construction side really has this taken care of and is aware of it, because these can sort of fall apart very easily if you're not meeting the administrative requirements. So I'll give another few seconds and we'll close that poll. Take a breath and drink my coffee here. Excellent. So this is good to see because first of all, it's people are recognizing that there is a capability. With that capability being out there, the petitions for funding, because it's now what I'll call, instead of a just cash out analysis, this is actually a cash out with an incentive. So the return on investment and the net cash out the door at the end of the day is a little bit obviously different, especially if you've got enhancements that bring you up to halving the cost of the project it really can make sense. So again, appreciate those people still here and listening, getting your CPs. Definitely appreciate the attendance. So next slide, please. So we talked about enhancements, and on that chart, I would be very clear. There's a lot of text here, and I'll apologize, but I wanted to put in a lot of text just because these are the requirements that instead of getting a 6% credit, you can get a 30% credit. So that vast increase, we really want to make sure that, hey, this is out there, it's something to keep in mind. So when they say prevailing wage and apprenticeship requirements, this is sort of what they mean. From a prevailing wage standpoint, and there's a lot more behind this, but most contractors that you're dealing with would have this already documented. And that's going to be the key is, are you making prevailing wage and apprenticeship requirements? Are you meeting those? So this is through contractors and subcontractors. So obviously in that industry, there's obviously a lot of subcontracting that goes on. One of the key factors that you've always got to keep in mind is when you get, presuming for the moment that you're getting American Institute of Architects progress billing, that as you're looking through that with your general contractor or whomever you're working with, whether it's internal, legal, accounting firm, understands that everyone below that, it can't just be your GC happens to meet it, it's got to be everything. So down to any tradesperson at the very lowest level, got to keep an eye on this. So you can see here, and I did not put down prevailing wage rates. The Department of Labor does a decent job of this. If you go to that website, the IRS has put down a few links. There's a few different categories that you would need to look at prevailing wages. It is hyper specific to localities. So it's not regional, it's not sort of a national prevailing wage, especially if you're dealing with a GC who has a nationwide reach. You want to be sure that they're not just saying, well, my subcontractor knows the prevailing wage and they've done this. This is, again, you want to get something sort of in representative form to you that this is being met. On the apprenticeships, and so prevailing wage is obviously, you know, how much you're actually paying. It's very specific and you would want to make sure you meet that. Onto the apprenticeship, this is actually a three-pronged approach to this. And this is one, again, which it may not be something that happens with regular construction contracts, but when you're in this realm to multiply your credit times 5, you definitely want to understand what's happening. So this has got the labor hours, the ratio, and the participation requirement, which I'm not going to read it out, but what it really stands for is ultimately you need to be sure that what you've got is you've got the folks working on it that sort of makes sense, first of all, from an apprenticeship program, who's registered, what does that mean? And even though 12.5 or 15%, that's, again, it changes year over year, so you just want to keep an eye to that. With that 15%, that becomes, again, a tracking and substantiation issue, where, okay, identified XYZ subcontractors having 3 apprentices, they're doing 50% of that subcontractor's work at the next level up. So it's got to be a blended 12.5 or 15%. And that could be, there are areas that they'll muddy the waters, and this is one of them. So you definitely want to be sure that from a documentation standpoint, not just your progress bills, not just your invoices, that you're aware of, here are the expected hours, and you keep track of that throughout the project. The ratio requirement you can see here, and this is really a making sure that you don't just have a boatload of apprentices that are sort of off on their own doing whatever their trade happens to be. They actually need to have journey workers that are in a comparative ratio to the apprentices. So it's not just, you've got what I'll call the old stuffing rules or anti-stuffing rules, where you've got a bunch of apprentices and only 2 or 3 journey workers, and you still need your 15%. And then lastly, you can see here, 1 qualified apprentice who employs 4 or more laborers. So this was an onerous requirement, onerous requirement, apologies, an onerous requirement for a lot of the smaller subcontractors. But again, we're talking about the level of investment and getting 5 times the credit. This is one where that's a negotiation, but you have to absolutely say, at least if you're at 4 or more, has to be 1 qualified apprentice. Most smaller subcontractors do anyway, purely as a consequence of pipeline and getting folks into the industry. But again, got to check the boxes throughout. It's not something you can go back and easily recreate at the end of the project. It's not something you can easily recreate through AIA documentation. This is one that you would need to have each subcontractor's agreement, each GC agreement, and really understand how to tie in the time to that. So if you can go to the next slide, please, Alana. Excellent. So Sandy mentioned these briefly, and I wanted to go into a little bit more detail just because this is one that I would say from the standpoint of, it's an interesting requirement. It's interesting for what's included, but it's also very interesting for what it excludes. So domestic materials on that chart, again, if you looked, it was the second one down. It says if you have domestic materials, you can have a potential 10% increase in credit. So step 1 is prevailing wage. and prevailing ratio in apprenticeship, you're at 30%, up from 6%. And then if you don't have prevailing wage and prevailing apprenticeship, this is 2% or 10% increase in your credit. So if you're at 30%, you can bump it up to 40%. And just to be clear, this excludes offshore wind. If you happen to be looking at offshore wind, they have their own set of rules. You can still get the credit, but their requirement for what materials are used is a little bit different than what the traditional one is here. This has been, again, an area of a lot of consternation for a lot of folks. It's got to be U.S. content steel and iron. And in view of some of the steel tariff issues that have taken place over the past 10 or 15 years, it's interesting that that's in there, but it's also more interesting in that it only includes steel and iron as opposed to photovoltaic cells, for example, or certain fiberglass materials for wind turbines. With that being said, again, iron and steel, if there happens to be a frame, for example, for a solar array, it's something to, again, keep track of. However, where your subcontractor, where your contractor happens to buy steel for the underlying infrastructure is important to keep track of. This, again, there will be unscrupulous actors out there. Documentation here is key. Not saying anybody wants to sue anybody else, but it would be sad to see you miss out on 10% of a significant investment because someone went down to the lowest cost provider instead of going US steel and iron. And so here, just to be clear, I wanted to put down what the projects were. Domestic content for manufactured products. You can see there it goes from 40. It's a little bit weird how it goes, but there you go. It goes up to 55%. And then steel, iron, or any manufactured product. And there was an argument initially about, well, what does domestic material mean? If we have it all generated somewhere else, manufactured somewhere else, and bring it to the US and put it together, does that work? The IRS said no, absolutely not. It's got to be from the beginning to the end. So anything from sort of ground up, you need to keep track of and make sure that you've actually got the documentation for that. So this is WAFs of, and I'll be very clear, this is WAFs of the sort of buy US argument from years ago. This is nothing more than, listen, we're going to give you the credit. We're also going to enhance it if you use US-based materials. So the other part I did mention, photovoltaic cells don't happen to be here. And what I would say down below, the last one will work our way back up. You have an exception if the domestic materials are not available. So we did have a steel shortage for a period of time when the tariff fights were going on, or domestic materials would increase the cost by more than 25%. I have not been made aware of anything that's come up against this yet, but I would assume that, again, I'll say it and I'll keep saying it, sort of beating it in everybody's head that documentation and substantiation would be key here. If you are not using domestic materials, you've got to be able to show that the cost is more than 25% over. And then lastly on this slide, just to sort of step back, 2024 tax exempt entities must meet the requirement for a refund direct pay. And this is something very specific to 501A entities. You can actually have your credit reduced if you don't meet this requirement. So not only is it an enhancement that you can get a benefit for, that's the carrot, this is the stick of that side of the equation where your credit will actually be reduced after 2025 if you don't meet this requirement, regardless of the enhancement, your credit gets eliminated. So something to keep in mind that if it is material specific and material heavy, most of these will be, but really the documentation here, you could lose your credit in its entirety, and especially in direct pay, dollar for dollar, it could be a significant impact. So you go, next slide, please, Lana. So energy communities, and this is different than the one prior, which was more so on socioeconomically depressed areas. This is again an enhancement, and this is the ARCGIS I was talking about, or ARCGIS. This is the GIS survey. You can go onto the DOE and it'll actually show you where your energy communities are. This is really for brownfields, coal mine closures, coal-fired power plant areas. This is an enhancement for, we'll say, the Superfund type enhancement. Your credit will be enhanced if you happen to be going on a remediated area, or, and again, it's hyper-specific, but the metropolitan statistical area on or after 2019, I'm not going to get into the math here. It really is, you go to the ArcGIS site from the DOE and you type in your address, it will tell you if you're in a metropolitan statistical area or non-metropolitan that has. And that is the easiest way to go about it. You type in your address, it'll tell you that. There are brownfields maps out there, but that ArcGIS is the key here. So this is one, again, it may be very limited usage, but it's out there. And if there's a choice of a few different areas, it may make sense to take a look to see if it would be applicable. So next slide, please, Lana. So direct pay, and the main key here that everybody's here for, just because this is the big change, Historically, for-profit entities would always take their credit and would be able to use it against certain amounts of tax due. And some of them were refundable, some of them were not. The vast majority were not refundable, so you had to carry forward, but you had a tax benefit. So there was a return on investment and for-profit entities. And who was left out were the 501, the tax-exempt entities, most governmental agencies, tribal nations actually was another big one. And oddly enough, if you happen to be in Tennessee, the Tennessee Valley Authority, the TVA is now in there. So direct pay provides an avenue. Thank you, Alana. Direct pay allows an avenue, as we discussed, that you've got a form, you roll up as if you were a for-profit entity, but instead of actually paying tax, you get a check cut at the end of the day. So the IRS calls it elected payments. Direct pay, they use a couple different ways. So the IRS is very clear to say, we're concerned about this. As Sandy mentioned, there are 13 credits that 501A or nonprofits can actually have a direct pay. And I'll refer everybody, the link is a little bit further on, but just to, if there's something to stick in your mind, it's publication 5884. There is a chart on page 7, which I'm going to refer to a few times. It is amazing. And what it does is it tells you each credit's name. And then if you happen to fall into one of those categories, if you're a Tennessee Valley Authority person or have a foundation, you can actually go in there and see across sort of by credit, is it a direct pay and can you transfer it? And obviously transfers are for for-profit entities, but something to keep in mind, that chart, Pub 5884 is fantastic. So if you do look on that page 7 of 73 within that PDF, at the very top of your 501A, there's 13 credits, all of them have a P next to it, which means direct pay is available. So just to focus on this just for a brief second, we talked about the production tax credit and the investment tax credit, the existing 45 and 48 being replaced by 45Y and 48E in 2025. The commercial clean vehicles, the nuclear power, which again is some people view that as dirty power versus clean power. It's out there if you happen to be looking into that. The refueling property tax credit, which we talked about for EV charging, the advanced energy and clean fuel. So again, there are some of them out there that we are not discussing today, but maybe worthwhile to take a look at because 501A and nonprofits and foundations can actually take advantage of it in the direct pay. But based on time, we did 2 of the most popular, which are the PTC and the ITC. So next slide, please. So direct pay, and there's a lot of text here, and I'll say there's a lot of text for the next few slides. That's purely because we want to be very clear about what's required, what's needed, and what has to take place. So I put the Internal Revenue Code section 6417, and I'll be very clear up front, this is still somewhat of a gray area. There are some developments that are ongoing. However, as of last December, they finally got the portal up and running. There's still a lot of questions out there. They add to it constantly, which is why I put down the IRS website there. They're adding to that, I would say, every month or so, even sometimes more frequently. Some of the frequently asked questions are great. Some of them are sort of a, we already knew that kind of thing. However, what they do is they take the somewhat dry language that they put out historically and sort of driven that home. With that being said, the key steps: identify the project, tax year, and satisfy all the credit requirements. Substantiation is key. I told you I'd say it a bunch, and here we are again. And the pre-file. I put this down. There's a bunch of documents out there that go through pretty good detail on what you need to do. I put this down with, there's a boatload of information. There's a lot of text here. However, that process is a massive data gathering effort. The reason I say however is because once you get that all into place, this was where the property should be placed in service. What does placed in service mean? Does it mean fully installed? Does it mean turned on? Generally, placed in service means it's turned on and doing what it's supposed to be doing. So for example, you're selling power back to the grid, you're generating solar, hydro, biomass, whatever that happens to be, placed in service. And notice, just to be very clear, with the credit form, you see construction began on. This is saying you need to pre-register, you actually need to have it placed in service. And the IRS, and Sandy made a very good point earlier saying it's got to be placed in service. The IRS uses and couches it in terms of it should be placed in service. We've always been on this side of it needs to be in service. It's not a should, it's required. So something to keep in mind, again, lastly on the direct pay for this section is that pre-file registration is significant. It will take time. The 120 days is a guide, I would say, 120 days in advance. The IRS, at least from the folks I've spoken to, they are backed up. They're working and trying to hire people as quickly as possible. But my anticipation is any missing data, The benefit is always reply quickly as soon as possible and try to get involved earlier rather than later, and find a person that you're dealing with, whether it's an agent or someone who's been assigned to it, that can act as your advocate. So next slide, please, Alan. So a couple of resources just that I think are helpful. Again, significant waiting period, 120 days prior to return. And they said there's some pitfalls here, which is use your proper federal employer identification number. This is move quickly and get in line that Sandy mentioned at the beginning of the hour. It's really key to get in as early as you can in line. And again, that runs counter to the it's got to be placed in service when construction starts. There is a lot of planning around this. And I would say the planning around this really has to be what's our ending look like and how do we sort of step back from there from a month's perspective. So here, once filed, a return of election must be made. I put 990T, should be T with 990. And then really the key here is the registry. And I put it here as the pre-file registration tool. There's the Pub 5884. That particular publication, in absence of a lot of the other IRS publications that are out there, it's easy to read, it's significant, and it walks you through step by step with quite a few good screenshots. They can actually walk you through the pre-file registration tool to say, you're going to need, and they give you a big block of data right up front. It goes through screenshots. It says, here's what you need to do, common pitfalls. They spent a lot of time and a lot of effort, as evidenced by them not having it open until December of 23. There's a lot there. And so clean energy, again, you can see the Pub 1502 is also helpful just because it gives you a little bit more color to what you need to do before you get in line for that. So page 7 to 73 for 5884. So next slide, please, Amanda. Polling question 4, has the foundation signed up for any IRS pre-filing? Yes, no projects yet, but we are looking. We will talk about a few things to keep in mind as you're doing this. From the standpoint of registration packages, what needs to be included versus executed, there's key is always to keep in mind a timing perspective, not only timing of when project's going to be complete, placed in service, but how to pre-file what needs to be included, because if you happen to have a delay in one project, you want to be sure, again, as the process is ongoing, to keep everyone apprised, that being the IRS and also anybody you're dealing with, whether it be accounting firm or a law firm. Because obviously, end of the day, this ends up on a tax return, and it presumptively, from the IRS's view and the U.S. government's view, this is going to be a significant dollar amount. So we'll give that another few seconds, and we'll close that one down. Excellent. So, not surprising. Again, I think this is sort of a burgeoning area, and I think there's education and then there's execution. The education is important. There are, again, we'll talk about some of the third parties out there. The key is really, is there a project that makes sense, whether it's from a grantee standpoint or otherwise? From there, what needs to happen for us to take advantage of it to sort of get our return on investment for that? So next slide, please. So credit transfers, I put this in here just knowing that there is also some grantees out there that may have this. This is not available for nonprofit entities. So this is only for-profit entities. With that being said, in that chart on page 7 of 73 in that Pub 5884, they'll actually go through, it's got a P and a T. P for direct pay, T for transferable. And as you go through that, there are a significant number of credits for certain types of entities that you can transfer. So for example, if you have a for-profit entity that has not been making money for a period of time, you can actually transfer that credit and you can get a payment in cash. You still have to pre-file for registration, and it must be provided to an unrelated third party. And that unrelated third party, they've been extraordinarily clear that that has to be completely unrelated. So if you are an IRS person, under Section 318 related parties, it's a very broad view. And we'll talk about self-dealing briefly, but it's got to be an unrelated third party. And I would say the key would be not having anyone who is, whether it's someone who's contributed, someone whose names actually shows up on your 990, anything along those lines, anyone who's gotten any pay, has any contracts with, et cetera. So a credit transfer statement must be completed as well, very similarly to the direct pay. It just happens to have all the information. Georgia has been doing this for a number of years for their state level credits. It's got to be transferee, transferor, and kind of goes from there. And then your tax return, similar to your direct pay, is going to be included there as well. So next slide, please, Alana. So wrapping up a little bit, we've got a couple more things here for key considerations. There are unscrupulous actors out there. When we asked the question earlier about if you've received some third-party mailings, similar to what I'll call the employee retention credit and some of the PPP loan actors that are out there. There are some folks out there that are just looking to say, hey, if there's any way we can sort of squeeze some money out of helping out, and regardless of documentation, we always just want to be very cognizant of who you're dealing with is reputable, and once they're reputable, do they have the substantiation documentation that you need. The self-dealing we talked about very briefly earlier, that's one that you just want to be sure not only does it have to be to an unrelated third party, just in general, to keep in mind obviously for the nonprofit space, who you're involved in, making sure you keep that in the back of your mind. And then lastly, this is a gray area that's currently out there. The IRS has proposed regs that just closed in late, that should be 2023, I apologize. Chaining. The idea of chaining is that you could purchase a credit and then get direct pay. And the idea was that there were certain third parties that were saying, listen, I can go out there and act as a factoring company. I can go out there and buy a bunch of credits and then get a direct payment. So I buy it for 80 cents on the dollar, turn around and get direct pay. The IRS was originally proposing regulations that saying, we've got some issues with this. There was significant comments and backlash and saying, listen, you can't purchase it and then turn around and using direct pay because they think that's just creating a secondary market that they're not, it doesn't meet the requirements and it doesn't meet their desire, what's happening there. And also from an audit perspective, if you've got 2 or 3 transfers and then direct pay, trying to audit the direct pay, you'd have to go back through 2 or 3 hoops to get back to the original entity. So currently there are proposals. They did finish a comment period. I put the links there just in case you want to take a look at that. That's a to be continued area, but something to keep in mind as an open question, I would say at the point. So with that being said, Alan, if you want to go to the next slide, please. Some final thoughts, and I'll turn it back over to see if there's other comments here. We're coming close on time. There's a lot of activity that's been happening in the secondary market around this, and it's going to become more significant. You're going to have a lot in what I'll say in a competitive space. The credit syndicators for folks going out there looking to finance certain things or finance certain things to get a 1% interest in a partnership. So providing them cash and getting sort of extracting the credit. That is becoming a bigger issue now than it has been in the past. And our expectation is that market and that secondary or tertiary market, depending on where the chaining rules end up, could be hugely significant. And it's just something to keep an eye on. So with that being said, there are a lot of benefits, documentation, substantiation, and I'll turn it over to Sandy, Scott, Anan, and the other Sandy, if there's any closing questions or comments.
Great. Thank you very much, Nick and Sandy. Thank you for taking us through that. A question did come up. I know we don't have much time, so I'll try to be very quick with this. But the question is a foundation. It says, my foundation is thinking of installing solar panels. Which credits should that foundation be thinking about, and what pitfalls should they be looking out for?
So Nick, maybe I'll take a stab at this one and then layer on your thoughts. And frankly, Scott, I think that maybe all we'll have time for today.
Seems like
and we'll get everybody out at noon and they could go for their lunch. In terms of a foundation that's going to be implementing solar panels, and we have had a lot of discussion on this that we've seen, so that it's certainly it's been under consideration, and I'm aware of a few foundations that are doing this. That you know, the first thing to think of is not what our topic has been for the most of the day. It's really it's the fact of what you're doing. You know, the pros are you're going green, you're using renewable energy, you can have a reduced electricity bill, in fact. So those are all good things. And a good news, at least with solar panels, from what we've been seeing, is they last for a while, like 25 or 30 years, and not a lot of maintenance. You know, having said that, even when you do get a 30% or even up to 50% credit, if you're in the right spot, there's a significant cost to adding solar. And one final thought that, you know, might seem obvious when you think about it is it's good to be in a place that has a lot of sunlight. So that's important as well. Well, one other thing that we've heard of, there's a lot of space constraints, and solar energy storage is expensive. So that's another thing to be thinking about. When you get past that, really the thing to think about is you really do have, and something we've touched on, what Nick went into in some detail, is that there's the ITC and the PTC, those two type of credits that are both out there, and you do usually have a choice. and you want to crunch the math on that to see which one is going to end up better. The ITC is based on your cost. The PTC is based on the kilowatt hours that you're going to produce over 10 years. So that's an interesting way to analyze it. And then all the things that you've heard in terms of make sure you capture the right expenses. That's something to go over with your CPA or the developer. And remember the different requirements that need to be documented that Nick went into detail, the wage and the apprenticeship and the opportunity if things are domestically made. So those are all the considerations I could think of. There are others. Nick, did you have anything else you want to maybe layer in on that?
I would just say from the standpoint of the 501 and nonprofits, it's always, is there any state or local incentives? And that would be, again, on the nonprofit side, it would be special financing, reduced interest rates, et cetera. On the for-profit or grantee side, it's always worthwhile to take a look and see if there's a accompanying state or local incentive, whether it be property tax abatement, state energy level credits, something along those lines. So it's always, you encompass it in total. For nonprofits, not a lot in the state and local realm, but for-profits and grantees, it's something to take a look at.
Great. Thank you. I think unfortunately we've run out of time. We're over the time limit here. There are a couple questions that were raised. Please note that we will answer those questions to you after this. Just once again want to thank you, Nick and Sandy, for providing us with your valuable insight on this and how it could help our private foundation community as well as those not-for-profit organizations that our foundation community assists. And I will hand this back to Alana to take us through, I guess, some final housekeeping items.
Thank you to our speakers, and thank you everyone for attending. Please remember to complete the short survey prompted at the close of this webinar. A copy of the PowerPoint slides and a recording of today's webinar will be made available to attendees via email within the next few hours. Thank you again, and have a great rest of your day.